Hello, I'm Tina Quigley with Centellus Performance Solutions, and I'd like to share a bit about cash flow forecasting. So, what exactly does cash flow forecasting mean? Let's break down what you need to know. First, cash flow is the net amount of funds coming in and out of any organization. In accounting terms, the debits and the credits. A forecast based on cash flow is different than a budget in that it details when revenues and expenses are likely to occur, not just when they're projected to occur. Cash flow forecasting is important because it provides more precise balances, net interest margin, and margin projections than budgeting alone. More accountability with line of business stakeholders, stronger modeling to create what if scenarios, and numerous other benefits. As financial institutions look at balance sheet planning, cash flow forecasting accounts for the interest income and expense from your loans and time deposits or shares, as well as the runoff from payments and prepayments of outstanding loans. Incorporating cash flow forecasting into your planning makes it possible to process fixed and adjustable records across all instrument types, adding prepayment assumptions so future cash flows reflect a more realistic view of customer and member behavior. For truly accurate cash flow forecasting, you want to start at the instrument level, taking into account balances and yields based on runoff projections, prepayment expectations, interest rate scenarios, and optionally funds transfer pricing spread. You'll need to divide the consolidated balance sheet into smaller line of business balance sheets or profit center balance sheets, with your level of granularity varying by institution size, the number of plan contributors, or whether you centrally manage pricing and volume goals, and how you distinguish fixed rate versus variable rate portfolios. Once you've defined the right profit centers, it's important to assess the current position of your portfolio as the basis for cash flow planning. Look at volume projections, considering near-term runoff, historical origination levels, and current pricing and volume trends. Applying funds transfer pricing to the forward balance sheet takes cash flow forecasting a step further, unifying planning and budgeting with profitability measurement and reporting, as well as informing performance-based cash incentive compensation plans. Finally, to make cash flow forecasting as effective and accurate as possible, ensure you have a robust system and processes in place. For example, you'll want the ability to merge the existing and planned book of business, as well as to process fixed and adjustable records across all term loans and deposits. Read on to learn more about cash flow forecasting and to see how Axiom software has helped other financial institutions improve their processes.